Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Thank you for tuning into my video today. We're hearing a lot of stories, a lot of talk about inflation all over the world at the moment. Naturally, the Russia-Ukraine conflict is putting pressure on oil, gas, commodity prices, and that is driving up prices at supermarkets, petrol stations, and obviously putting pressure on households. We've seen headline inflation figures in Australia at record highs, certainly recent record highs, and this is naturally putting pressure on central banks to increase interest rates. So what, as Australian expats, as investors, can we do, should we look at when it comes to protecting ourselves from rising inflation? Let's have a look at a few areas. Now, my first tip for you is to review any debt that you have and the interest rates that you're paying. Naturally, as inflation is rising, we're going to see more pressure on central banks to lift the cash rates, which is then going to put further pressure on lenders and banks to increase the interest rates on your debt. So consider your options, speak to your mortgage broker. If you have mortgages on property in Australia, for example, make sure you reach out to your broker, whether you should be fixed or variable or change lenders, reduce the rates, but certainly start considering your options if you haven't been doing so already. And given that we are going to continue through this rising rate environment, probably at least for the next 18 months, then make sure you're not simply ignoring things because those rates are likely to go up unless you're on a fixed rate. My second tip for you is to review your investments for any interest rate sensitive investments that you may be holding. So typically this is going to be investments like bonds, other fixed income instruments, where rising inflation, rising interest rates may put downward pressure on the actual bond prices. So make sure that if you are holding them, you're comfortable with the exposure that's sitting there, you're aware of the interest rate risk, and you're prepared for any declines, particularly if you're going to need access to that capital in the short term. Because you may find that the downward pressure on bonds over the next 18 months means that that money is not going to be as much as you thought it might be, or that the investments are not as safe as you were expecting. So certainly review your options for that interest rate sensitivity in your portfolio. My third tip for you when it comes to reviewing your investments is to review your exposure to growth versus value investments, equities, stocks, for example. So typically we sort of refer to growth stocks as those stocks on high earnings multiples trading at relatively high valuations. So a lot of the tech sector has made up a lot of the sort of growth allocation in the past, and we've seen a significant underperformance of value investments and value methodologies over the last 10 and 11 years. Now, obviously without our crystal ball, we don't know if that outperformance is going to continue or if we'll start to see the value play start to actually outperform growth investing. So make sure you review your investments, review your exposures, make sure you're comfortable with the level of diversification that you have, and you're aware of how much exposure you have to growth and how much exposure you have to value, and that you're comfortable with the risks. My fourth tip when it comes to reviewing your investments is to just make sure that you're comfortable with your overall asset allocation. For the first few months of 2022 and even in 2021, we saw a lot of volatility. It's very likely that volatility is going to continue, so you may find that your asset allocation has veered off course if you've not been paying attention. So make any adjustments that you need to, speak to your financial planner, and make sure that you're comfortable with the level of risk and your expected returns associated with your investments. And my final tip for you is to simply review your cash flow. So review your weekly, your monthly budget, review the incomings, outgoings, particularly as we see rising pressure on transport costs, rising pressure on interest rates, which is going to mean that debt repayments are likely to increase, and obviously prices at supermarkets, we're seeing some pretty hefty increases there as well. So make sure that we're not simply ignoring these costs, make sure that we're comfortable with our savings, we've got those emergency funds put away, and that we're comfortable with our household finances going forward. Now, if you have any questions about inflation, around what that means for you, around your debt, your interest rates, or what other emergency funds or anything else you should put in place, please do feel free to reach out to me. Drop me a note in the comments if you'd like to. Please remember to subscribe, and thank you very much for tuning in.